What if I told you Arista networks might be mispriced? We're about to find out using rigorous cash flow analysis of Arista networks. Will the market's valuation hold up? Let's see. Before diving into the numbers, let's establish the business context. Arista Networks develops, markets, and sells cloud networking solutions in the Americas, Europe, the Middle East, Africa, and the Asia Pacific. The company's cloud networking solutions consist of extensible operating systems, a set of network applications, as well as gigabit Ethernet switching and routing platforms. As a technology company valued at $164.5 billion, they employ 4.4 thousand people. Now let's analyze the valuation. Alright, here are the numbers. Arista Networks is trading at 130.73, but our DCF calculation puts the fair value at 111.00. That's a 15.1% spread, so let's see what's driving this difference. Here's how we're modeling the growth. We're using a weighted regression of historical and Wall Street analyst consensus estimates, which incorporates forward-looking growth expectations from professional researchers. We're assuming 25.1% growth initially for 5 years, then tapering down to 4% over 10 years total. We're also projecting an EBITDA margin of 36.8% based on historical operating efficiency. Let's examine our risk assumptions. We use Professor Damodaran's industry beta data adjusted for this company's risk profile, giving us a cost of equity of 8.3%. The cost of debt is 3.2% after tax benefits. This results in a WACC of 8.3%, which will serve as the discount rate in our DCF valuation model. Let's examine the cash flow progression. We project 25.1% growth for 5 years, then taper over 5 years to 4% terminal growth. Each phase reflects different stages of the company's development. The DCF journey concludes here. We've built up to an enterprise value of $139.5 billion, where the terminal value accounts for 72.6% of the total. After accounting for minus $2.7 billion in net debt, the equity value comes to $142.2 billion, or $111 per share. This reflects 4% terminal growth and 8.3% WACC assumptions. Sensitivity analysis shows how our 111 valuation changes with different assumptions. The 25.1% growth rate and 8.3% discount rate are the most critical parameters. Test your own assumptions at Stockoscope.com. From growth assumptions to final valuation, we've built a DCF model for Arista networks. The beauty of DCF is that you can apply this same methodology to any stock. Check out Stockoscope.com to analyze other companies and refine your valuation skills. Subscribe for daily stock analyses and like this video to support educational content.